Welcome to the Multifamily Investor Nation podcast. I'm your host, Dan Hanford. This podcast is unlike any other podcast you have been listening to. The guests on this show are true, active real estate investors closing real multifamily deals. Whether you are an active investor looking to up your game or a passive investor looking to learn more about how multifamily deals are structured, I promise you will thoroughly enjoy this podcast. So be sure to hit that subscribe button so you'll be notified of future episodes. For those of you that are interested in investing passively in these types of deals, in solid, cash-flowing multifamily deals throughout the Southeast, then visit my group, PassiveInvesting.com. Fill out the investor interest form. That's PassiveInvesting.com. If you've closed a multifamily deal in the past 12 months and want to be on this podcast, then send an email to Stacy@multifamilyinvestornation.com for details. Now let's get started.
Welcome to the Multifamily Investor Nation podcast. I am your host, Whitney Elkins Hutton, the Director of Investor Education here at PassiveInvesting.com. And today I'm joined with Bobby Larsen. Bobby, welcome to the podcast.
Thank you very much, Whitney. It is a pleasure to be on here. I've been a longtime listener myself, so pretty excited to be here.
Well, awesome. Bobby, before we dive into Canyon Spring Townhomes, 61 units in San Diego, California, tell us a little bit about yourself and how you got into multifamily investing and where you're at today.
Yeah, so I'm a San Diego native, or Southern California native, I should say. I'm living in San Diego now. I have been in real estate pretty much my entire career. I began an undergraduate working on the brokerage side of residential. Quickly after that, worked for one of the largest investment managers in the country, and then slowly went down working for smaller owner-operators before eventually fulfilling my dream, which was to start Vanamore in 2017.
Are you a passive investor looking to diversify your portfolio? The team at PassiveInvesting.com is thrilled to introduce the investment opportunity of our real estate debt fund. This debt fund places first position loans on rehab projects sourced by our private lending company called Rehab Wallet. Since we started this debt fund in June of 2020, we have funded over $260 million in loans to borrowers across the United States. As a limited partner investing alongside PassiveInvesting.com, you can be part of the success of Rehab Wallet. With a minimum investment of $25,000, you can seize the opportunity to earn a preferred return of 6 to 8% with a 90-day liquidity option to call your capital back. Our real estate fund has been a great investment for our investors to have a short-term or rainy-day cash reserve with a high-yield return option. Don't miss out on this chance to enhance your portfolio and your financial future. Visit PassiveInvesting.com to discover more about this real estate debt fund and start your journey towards a prosperous investment today. That's PassiveInvesting.com.
Awesome. We'll definitely have depth and experience here in the multifamily market. Well, let's dive into Canyon Springs Townhomes, 61 units in San Diego, California. When did this property close and what did you purchase it for?
This property closed in July of 2022, so it has been a while. We've been active out there since, and it closed for $16,350,000.
Okay. So we all know the story doesn't start there. Let's back up the timeline. When did you find this property? How did you find it?
I found it through a close broker relationship of mine. Obviously, since San Diego is my backyard, I have very close relationships with all the brokerage teams. And Seabury was marketing this. And Kevin Mulhern, which is a close friend of mine for the last 10 years, knew that it would be a great fit and reached out to me, although I was already looking at it. But it definitely helped to have an inside relationship there.
And were you guys the only group looking at it, or were there other groups looking at it?
No, it was a competitive field at that time. There were still a lot of very aggressive groups, especially in Southern California. It was a very interesting property given that it's all townhomes, large floor plans with direct access garages. It had a lot of interest.
And so when did you first notice it? I mean, you closed in July, but when did you notice it? When did you start looking at it?
So I knew that it was coming out because it was a couple different properties from the same seller. that it was a family-owned property at that time, that the children had inherited it. I tried to contact as many direct ownership relationships as possible. This one, I knew I couldn't peel it away at that point, and they were definitely going to go to market. So I had the one that I knew that was coming out and was keeping a close look at it. So when it eventually came out, we jumped on it.
So was that January, February, March? Help me with the timeline here.
Oh, I think I'd actually been speaking with the family for about 18 months. And then I knew that they were going through the broker opinion of value process, the BOV process, with a number of different groups. In earlier that year, I'd say it's probably January. And then it eventually came out in late February, I believe.
Okay. So that's helpful because these deals sometimes take a year or longer in order to get closed, right? Like you're building this relationship. You've got these contacts here that you're working. Okay. So you're looking at the townhomes, you try to go direct, you eventually go through the broker in order to get this under contract. It's a competitive market. You've got other groups looking at it. So how did you stand out from the group and how did you structure your contract to get it under purchase sale agreement?
Yeah, we like to pride ourselves in our ability to execute. So when we tie up a deal, we never seek to ever retrade on our price because we go in with pretty conservative numbers and we back test our renovation assumptions, expenses, and rent growth projections. So going in, we're really comfortable. And there's a little bit of cushion typically in there. At the end of the day, we want to let the sellers know, hey, we are a real buyer, A, and B, we are the last group to ever come back with you for additional extensions or price reductions or something further like that to give them a little bit of peace of mind. I think that helps. And again, there was a direct relationship with the broker who knew me as Vanamore as well as with past positions for the last 10 years. So I think that really helped. And honestly, I've been on the sell side as well. And there is just a peace of mind, perhaps even more than purchase price when you're working with the group that you know that they're going to be able to execute and they're going to be able to complete what they're saying they're able to.
Okay. So what was that listed for and when did you guys put it under contract? Can you tell us that?
Yeah, I'm trying to recall. It wasn't a list price. So typically the larger properties don't have a price listed with it, but it's typically included with a whisper price is what we call it. It's the broker giving an indication on where they think it will trade based off of their opinion of value as well as conversations with other sellers. And I believe, if I recall correctly, the original price was about $29 million.
All right. So you did get a little bit of a discount.
We did. The market was at the time going through a little bit of a bumpy patch, which it basically has ever since then. But I think this was about the same time as the first Fed kind of shock to the market where they realized inflation wasn't transitory and they really bumped up their expectations of where the Fed interest rates were. So it was the first bump of the many bumps we've seen over the last 12 months.
Stark difference in interest rates from January, February 2022 to when you closed in July. And we all understand that that interest rate generally isn't locked until just like right before closing. All right. So how did you structure the offer? Like due diligence periods, days to close, any extensions in there? And then how many rounds of offers did you guys go through and before you guys finally went under purchase sale agreement?
Yeah, good question. This one had quite a few rounds of the offering process because of the competitive nature with it. There was also a sister property that it was marketed with. So on their side, I could see why they're looking at offers across both properties, individual properties. So I believe there was about 4 rounds of offers through letter of intent. The initial one's letter of intent, and after that, they call it best and finals. And I think we had 3 best and finals throughout the process. And typically, our initial structure that we go out with is a 30-day due diligence period, 30 days after to close. And then we'll typically also try to structure in a 30-day extension in there. So a combined 90-day period, if all goes as planned. Sometimes we have pushback from sellers wanting to close quickly, but this was one of the cases where we were able to have that extension period in there.
All right. So you get it under contract. When did you actually walk the property? Were you able to walk all the units before, like during the LOI period, or did you wait until you got it under purchase sale agreement?
So this one didn't have an access agreement. So before the offering process or during the offering process, I should say, we'll typically walk as many units as possible. That's typically just the vacant units. So there's 3 or 4 units per property at that time, whatever is vacant, you like to see it. And then, like you mentioned, if you have an access agreement, you're able to start that process a little bit earlier while you're negotiating the PSA. But this one didn't. So as soon as the PSA was signed, we had all of our vendors set up, a roofing, plumber, electrician, to come out and look at every facet of the property. And at the same time, we go in and we walk 100% of the units. We think that's very important. I know some people do a certain percentage, 10, 25%. We think it is one of the most important processes to go through is to walk every single unit so you get an idea of your tenant base. Also gets you ahead of schedule on potential renovations that you know you're going to need to make when those units turn.
What was your overarching business plan with this property?
Yeah, so we had a pretty extensive interior renovation schedule planned on this one. The exterior was in pretty good shape, so we didn't have much work. We were adding some amenities, so we added a dog park, added a barbecue station, and enhanced the pool area with some additional furniture. But majority of the renovation strategy was targeted on the interiors. Great floor plans, like I mentioned. They're all spacious, so they're just under 1,300 square feet. They have direct access garages, so it really appeals to the families. It also helps that they're all 3-bedroom, 2.5 bath, same floor plans. This made things significantly easier for us. So once you get a scope that you want to work with, you can also buy quantities at scale, and it helps with pricing. So we went in, we resurfaced the cabinetry, swapped out the appliances with stainless steel before they had a mismatch of really, really dated white and some black appliances. So we upgraded those to stainless steel. We upgraded the countertops to hard surface white quartz, full paint job throughout the property with two-tone paint. And we did vinyl plank flooring on the downstairs, and we kept the carpet upstairs. We thought about doing carpet on the upstairs, vinyl plank on the upstairs. But given the families, we thought it made more sense, especially with stairs. It could be a little bit of a trip hazard for youngsters out there. So we felt like it was best to keep carpet on the upstairs.
Are you a serious real estate investor looking to break into the multifamily space? Or are you an experienced multifamily investor looking to level up your game by meeting new passive investors and creating new partnerships? Have you heard of the MFIN Con happening in Charlotte, North Carolina, June 12th through the 14th? The Multifamily Investor Nation Convention is a place to learn from over 60 plus high-level speakers and also to network with over 700 serious multifamily investors. If that's not enough for you, A-Rod. Yes, Alex Rodriguez, 12-time Major League Baseball All-Star with over $700 million of commercial real estate, including apartments, will be live and in person speaking at this event. Also speaking is the one and only Dr. Robert Cialdini, the godfather of influence and the award-winning author of the book Influence, one of my all-time favorite business books. Finally, we will have the CEO of Taco Bell, Mark King, joining us on stage to talk about leadership. Be sure to secure your tickets to this live in-person event as the tickets are going fast. Go to mfincon.com to find out more details. There are also sponsorship opportunities available for those of you who would like to have a booth at this event. For the details for this event and to purchase tickets, visit mfincon.com. You can use promo code MFIN Podcast, all one word, MFIN Podcast, to get $200 off tickets, and that's mfincon.com. Look forward to seeing you there.
So you get the property under contract, you begin your due diligence. How did that go? Like, were there any surprises upon due diligence?
I'd say there's always surprises, but if you go in expecting there to be surprises in your numbers, you can mitigate them. So in some aspects, our budgets came back a lot lighter than we're expecting. And then in some areas, it was a little bit higher. So we look to just overall have a budget that can encompass everything that needs to be included. One of the unexpected, until you really get in there, is doing sewer scopes of both the interior lines, but also the main lines. And that's a big item that I think most people do, and they should definitely be doing on older properties, because if you get an overly corroded mainline sewer system, it's pretty expensive. And we had one that we had to replace, but it was, again, within our budget that we expected. And thankfully, other items like the roofs were relatively new. We had very minimal budget needed on the roofs, and we had some money there. So overall, it actually came in a little bit lighter than we expected for our budget.
And so during this due diligence period, did you have any money down hard, or like what kind of earnest money did you put down on the property?
We didn't have any money down hard, which is great. The last couple of years, that was very prevalent, just day one to have hard money down, which makes the process difficult. Obviously, for us as sponsors, you have a lot of money at risk, and that could also provide a bit of a conflict of interest where you really want to make a deal to work if you have money down. That's not refundable. This one, we didn't. Typically, we will put 1% of the purchase price down as an initial deposit, and then we'll put another 1% down at the conclusion of due diligence. In this case, the initial deposit and the second deposit didn't become non-refundable until our due diligence period was up. So it gave us a great opportunity to really understand the condition of the property ahead of time without having any money at risk.
All right. So we talked about the physical due diligence. What did you find on financial due diligence?
Financials, I think at that time, it was very important to have a strong understanding of the delinquency report or the age receivable report. Now, what that is, it just shows, while there might be tenants in there, it's showing the tenants that perhaps are a month or two or even more late. And that was something we always requested, but especially out of the end of the pandemic assistance programs out there, it became one of the most important reports for us to see. And this property, like most that we were looking at, did have a little bit of elevated delinquency. And still, as those assistance programs were rolling off, those tenants, which may have looked current, but they were current because of the assistance programs, when those ended, there was a little bit of an elevated exposure to the delinquency, which we saw here, and we were able to work through it. We were very upfront with the tenants, and thankfully we had very communicative tenants that worked with us to really solve that issue.
All right. Well, let's talk about the financial piece, right? You're trying to put this property under contract and close during a time where interest rates started taking off, right? Like hotcakes. What kind of lending did you use? Was it public, private, the fixed rate loan, adjustable rate loan? Just give us all the nitty gritty details on that.
Yeah, so we actually did have a variable rate loan, but it wasn't a high leverage loan. This came back to another relationship that we had. So we put on a bank loan, which was 60% loan to cost. We typically don't go too high on the leverage scale. So we felt more comfortable with variable rates at that time. The spread, which is basically the bank's compensation in the matter, was low. And we were able to put on a nice interest rate cap. So our all-in rate was very attractive. We didn't have high leverage. And we were expecting this property to have some really good downside protection because of what we already saw in the interest rate environments. And obviously, it's been a bumpy road ever since there. So it's really come in handy to have those rate cap protections.
Okay. And so what was your rate whenever you closed, and where's your rate now?
Oh, just going into specifics. I like it. So spread on that property. We had a 250 basis point spread, so 2.15% spread over SOFR. We had a 3% and continue to have a 3% interest rate cap on there. And we continually look at if we are in a position to refinance to make sure that our DSCR coverage is being met. And that's really where we're looking at the downside protection. So even going into it, we had a strong DSCR with then market rates of 1.25, a 1.25x DSCR. And today we're sitting at 1.35. So if we wanted to, we could refinance it. But if we wait a little bit longer, part of the strategy is timing that refinance. And if you wait a little bit longer, you could perhaps pull out some more additional proceeds at a fixed, likely agency execution. So that's what we're looking at right now. Our in-place DSCR is very strong, but we still have quite a bit of loss to lease to run through, as well as the renovation program. We're only about 1/3 through the property. So quite a bit of upside, and we're looking forward to eventually refinancing it in probably a year and a half from now.
So yeah, in the next year and a half, you're looking to complete it. If you're 1/3 now, like the other 40 unit rehab, get those rents bumped to market rent. Now you have a higher NOI, and hopefully we'll go in stronger to refinance and pull capital out. On this current loan though, do you have like any prepayment penalty or lockout period?
No prepayment penalty, but there is what's called a minimum interest reserve. So basically the lender wants to know if they're issuing this loan, they want to get at least X number of dollars back. Typically, that's going to be equal to, call it 18 to probably 24 months of interest. So we're also short of that, but it aligns with our business plan. So it's not much of a consideration for us. We're almost there though.
Now you raised capital in this deal. So you walk us through the capital stack. Like you had a low leverage loan, but let's get into the numbers, what the capital stack is, what the general partnership is, and then what did you raise for the LPs?
Yeah, so internally we co-invest 10%. Sometimes it's a lot more. It depends on if we have a 1031 exchange from a previous property, and we typically roll over majority, if not all, of our 1031 proceeds into the next deal. So sometimes it could be as high as 25, 30%, which is what we had on another deal. But this deal, it was entirely new money, syndicated through our investors of high net worth investors in a single entity. Since it wasn't a 1031, we didn't have the need for a tenant in common. So it was a pretty straightforward structure. And they came in with 90%, and internally we raised 10%.
How did you structure this deal for your limited partners? Like, was it preferred return? Was there additional splits? Was there IRR hurdle in there?
Like most sponsors, we do have a waterfall and a promote structure. we like to keep it as simple as possible. Our investors most of them are very close family friends, but they're the doctors, the lawyers of the world. So they're oftentimes not as informed as us in the industry are. So waterfall structures can get complicated. We try to keep it simple. In this one in particular, we have a 2% acquisition fee. The preferred hurdle is an 8%. So investors get 100% of the cash proceeds up to an 8%. And after that, it's split 80% limited partners, 20% general partner.
Okay. And then what's the whole timeline on this?
So we'll look to either refinance or sell at end of a 5-year period. Typically, we like to have longer term holds. That's one of the areas that differentiates us, I think, from the industry. We don't like to flip investors in and out of deals, and I feel like they do appreciate that. So we'll most likely refinance this into a longer term, probably 7, perhaps 10-year hold.
Well, let's talk about, just in wrapping up, like what did you find easy that you thought would be harder? And then what was harder that you thought would be easier on this project?
Good question. What I thought would be harder and turned out to be easier was actually the equity raise. I was a little bit nervous going into this one, again, because we started seeing some turbulence in the economy in general, but also obviously the commercial real estate space. I thought I would have more pushback in terms of where do you think rates will go? Do you think it's better to buy a fixed income security today versus real estate? We didn't get too many of those questions. I think a lot of people saw the value of the deal. Our return projections were very healthy. And so we had quite a bit of an appetite from our investor network. So that was easier than expected. I would say the more difficult than expected was, again, on the financing side, just because we did have a variable component. From the beginning, we were intending on purchasing a rate cap, but during this short period of time, interest rates came up quite rapidly. The cost of that rate cap got more expensive. And you're sitting there in a position of, okay, if I factor in the cost of this rate cap, does the variable term still make sense? Or should I go with a fixed term structure, like an agency, Fannie or Freddie deal? So there was a lot more considerations and conversations internally on what the most optimal financing structure would be. And I think we ultimately got there, but obviously it was just more of a conversation. A lot of what we do is pretty straightforward, especially today. I can tell you 99% of what we do, if we're looking at a deal, it's probably going to be agency execution today. But then there was a lot more options and there was a lot more volatility in the different options that we had to consider.
Bobby, thank you so much for your time and expertise here today. If people want to find out more about you, where can they do so?
Yeah, find me on social media. I would say LinkedIn is by far what I use the most. I'm pretty active on LinkedIn. Great content being put out there from others, and I try to mimic that. I think I put out good content. Please read our newsletter that we put out monthly, but I'm pretty active on LinkedIn. Vandermeer also has an Instagram page that we're happy to share. Or contact information for myself and all of our associates on the team is available on our website. So please never hesitate to reach out to us. We talk to potentially new investors about deals they're looking at. We're very transparent up front in what we do. So please reach out to us.
Awesome. Well, Bobby, again, thank you so much for sharing your time with us here today. And we look forward to learning about your future deals.
Absolutely. Thank you so much.
Thank you for listening to the Multifamily Investor Nation podcast. I trust you enjoyed this episode. Take a moment right now to leave us a review and let us know what you learned. Also, don't forget to visit PassiveInvesting.com and fill out the investor interest form to invest alongside me in excellent multifamily assets located across the Southeast. That's PassiveInvesting.com. Thanks again for listening, and we'll see you on the next episode.